Asset turnover ratio. Asset turnover ratio is the measure used to determine how efficiently a company uses its assets to generate sales. If the asset turnover ratio is large, that means the company is more efficiently using its assets to generate sales. On the other hand, if the asset turnover ratio is less, then the company is not efficient in using its assets to generate sales. Asset turnover ratio is equal to sales divided by the assets. Larger the asset sales the company makes, the asset turnover ratio increases. Or if the company buys large assets, then the asset turnover ratio decreases. Retail and FMCG sectors, they have a high asset turnover ratio because they are asset light companies. On the other hand, utility and real estate, they are asset heavy businesses and they have an asset turnover ratio which is lesser than retail and FMCG. So it is better to compare companies within the sector instead of comparing companies across the sector for the asset turnover ratio. Asset turnover ratio can also be calculated as ROE divided by net profit margin into financial leverage, where return on equity is nothing but not net profit divided by equity. Net profit margin is nothing but net profit by sales, and financial leverage is equal to total assets by equity. Therefore, when the ROE increases, the asset turnover ratio increases, provided NPM and financial leverage does not change. In that scenario, ROE could have increased due to decrease in equity due to buyback, etc., as a result of which the asset turnover ratio could have increased too. When the net profit margin increases, asset turnover ratio decreases, provided ROE and financial leverage does not change. In that scenario, either the net profit margin could have increased due to the sales dropping, or the profit remaining same or grow, or due to the profit growing more than the sales. When the financial leverage increases, asset turnover ratio decreases, provided the net profit margin and return on equity does not change. In that scenario, the financial leverage could have increased due to the company growing its debt more than equity, or due to the debt remaining flat and the equity dropping due to the buyback, etc., which the company pursues. Readjusting the formula in the previous slide for return on assets to get return on equity will provide the DuPont analysis, which breaks down ROE into three components: ROA, net profit margin, and financial leverage. The efficient company is the one which increases either the ROA and or the net profit margin to grow the return on equity. The companies which actually increases the financial leverage to grow the return on equity will be riskier. Asset turnover ratio could be volatile due to the company making a large asset buy in 1 year and then divesting more of its assets in the next year. Therefore, it is worth looking at 5 or 10 years history of the company and see whether the asset turnover ratio had moved up or down year on year. It is a good sign if the asset turnover ratio had increased year on year over the last 5 or 10 years. It is not a good sign if the asset turnover ratio had decreased year on year over the last 5 or 10 years, or had been volatile over the last 5 or 10 years.